Prospect Capital Corporation, ticker symbol PSEC, is one of the largest publicly traded business and development companies in the United States. The firm focuses on lending to middle-market companies through a combination of senior secured loans, subordinated debt, and some equity positions. It was founded in the year 2004 and is managed externally by Prospect Capital Management. The fund's main attraction is its monthly dividend, which for many years has been among the highest in the BDC sector. However, the sustainability of the dividend has been under constant debate due to a long history of net asset value erosion and dividend reductions. For a long period, PSEC paid 6 cents per share each month, producing a very high annual yield. In late 2024, management announced a dividend reduction of about 25%, lowering the payout from 6 cents to roughly 4.5 cents per share monthly. This was the first cut since 2017 and reflected the need to align distributions with lower net investment income. At that time, the payout ratio had exceeded 100%, meaning the company was paying one more than it was earning. Management explained that declining interest income and a shift towards safer, lower-yielding loans made the previous rate unsustainable. Even after the reduction, the dividend yield remains extremely high, roughly 19 to 20% annually based on recent share prices. This yield is almost double that of peers such as Ares Capital or Main Street Capital, which typically yield around 9%. Such an extreme yield signals that the market doubts the dividend's long-term safety. While the payout is currently covered by net investment income, a future decline in earnings could easily pressure it again. In total, Prospect Capital has paid over $21 per share in cumulative dividends since its inception, but much of that came at the cost of long-term capital erosion. Long-term shareholders of Prospect Capital have not fared well despite the high income. Over the past decade, the company's stock price has steadily declined while many peers and the overall market have climbed. For example, between August 2024 and August 2025, the share price dropped from roughly $4.96 to about $2.76, a fall of about 44%. During that same period, the S&P 500 index rose nearly 20%. Even when accounting for dividends, the total return for shareholders has been negative in recent years. Over the last 3 years, total return has been roughly negative 45%. A 5-year investment with dividends reinvested would have produced less value than simply holding cash. In short, while the monthly income may look appealing, the erosion of share price and net asset value has erased those gains. Over 10 years, Prospect total return is estimated to be under 20%, while the S&P 500 delivered several times that. The company's performance ranks near the bottom of all business development companies. This poor track record comes from chronic dilution, expensive management fees, and periodic portfolio losses. Many analysts classify that PSEC as a dividend trap, an investment that offers eye-catching yield but continually declines in principal value. The net asset value, or NAV, per share of Prospect Capital has been declining for years. At the end of the fiscal year 2025, NAV was approximately $6.56 per share, down from $8.74 a year earlier. That represents a drop of nearly 25%. The decline reflects both realized and unrealized losses within the loan portfolio, as well as dividend payouts exceeding net investment income. Over the past decade, NAV has fallen by more than 50% with its heights in the early 2010s. Because of this, the stock trades at a massive discount to NAV. As of mid-2025, shares traded at only about 40% of book value, meaning investors pay around 40 cents for every dollar of assets on the balance sheet. By comparison, strong peers like Main Street or Ares Capital trade at or even about their NAVs, showing far greater investor confidence. This deep discount means the market expects further erosion or NAV or doubts the quality of Prospect's aspects. The company has also issued new shares through its dividend reinvestment program at times, which can be dilutive. If management ever succeeds in stabilizing NAV and improving sentiment, the stock could rise simply from the discount narrowing, but so far that has not occurred. Prospect Capital's risk profile helps explain the situation. Roughly 47% of its portfolio has historically been in subordinated debt or equity positions, which are the riskiest parts of the capital structure. Concentration risk is high, with about 40% of assets tied up in just 4 large investments. One of those, national property, REIT, has been problematic with negative cash flow and heavy debt. The rest of the portfolio consists mainly of first lien senior loans to middle market companies. Management has been reducing exposure to collateralization loan obligations and second lien debt to make the book safer. As of mid-2025, about 70% of the new investments were first lien loans, a sign of a more conservative approach. Interest rate sensitivity is another key factor. As a lender, PSEC benefits when rates rise because its floating rate loans yield more, but falling rates reduce that income. When the Federal Reserve began cutting rates in late 2024, Prospect's loan yields dropped, pressuring net investment income and prompting the dividend cut. On the funding side, the company carries significant leverage. Its asset coverage ratio stands near 183%, safely above the regular minimum of 150%, but leaving little room for error. If NAV keeps falling, that cushion will shrink further. Credit ratings agencies such as Standards & Poor's and Kroll both downgraded PSEC's debt to below investment grade in 2025, reflecting concerns about asset quality and concentration. These downgrades could increase borrowing costs over time. Valuation-wise, the market clearly prices Prospectal Capital as a high-risk, high-yield instrument. A discount of 60% to NAV and a yield near 20% suggests investors expect further troubles. The external management structure also plays a role. The advisor charges roughly 2% of assets as a management fee plus incentive fees, one of the highest in the industry. That means a large portion of the income goes to the manager rather than shareholders. Critiques argue that the external setup encourages asset growth over per share value growth. Management has been criticized for not repurchasing stock despite the extreme discount and instead issuing shares that benefit the manager by raising assets under management. Overall, Prospect Capital's story is one of high yield but weak total return. The company provides steadily monthly income, but capital erosion and dilution have offset those gains. If management can stabilize NAV, maintain dividend coverage, and slowly rebuild trust, the stock might recover somewhat from depressed levels. For now, however, the risks remain elevated. My meter rating is as follows: income potential 8 out of 10, risk 5 out of 10, sustainability 4 out of 10, execution and flexibility 6 out of 10. Overall, my meter rating is 6 out of 10. PSEC remains a speculative income play suitable only for investors who fully understand the risks and accept possible further declines in value. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.